Hey guys, welcome back to the channel. And if you are new to investing or even thinking about starting it but don't know where to begin, this video is for you. Today I'm going to be breaking down a simple step-by-step guide that anyone can follow, even if you've never invested before. So just a clear, calm explanations that help you build wealth over time. And let's get started. So why does investing matter? Well, because investing is one of the most reliable ways to grow your money faster than traditional saving. When you leave money in a savings account, it does grow, but it grows slowly, often slower than inflation. But when you invest, your money has potential to grow at much higher rates over the long term. And here's the part that most beginners don't realize. You don't need a lot of money to start. Even small amounts like 10, 25, 50 quid a month can turn into something meaningful over time. Investing isn't about being rich, it's also about using time to your advantage. And to put in perspective, the average interest rate for savings accounts in the UK is roughly at the minute 2.12%. Now, the average return for the UK stock market return, so that's about 5.4% per year, or 12.1% average return for the US market. So, to put it in more of a perspective, then if I put in, £100 each month, and do that for so many years, say 20 years, in my savings account, I have roughly about £30,000. Now I would have got nearly 6 grand of interest. Now, if I invested in the UK market, that would be sitting at 43,000 with 19,000 of interest gained. But if I invested in the US market at the same rates of like depositing each month, I would have £101,000 with 77% interest gained. Now, of course, past results does not mean that it's going to guarantee that in the future or guarantee future results, but it's quite impressive to see how much on average that if we did this on a long term, how much we would get. And that brings on to the mindset that you need. Because before you invest a single pound, you do need the right mindset. Because investing is long term. And for people that say, oh, well, I do short term trades, I invest in the short term, I gain a few percent. That's not investing, that's trading. Because it's not about getting rich quickly with investing, it's about building wealth slowly and consistently. Because consistency beats timing, and most people try to predict the market when to buy, when to sell, is it going to go up, is it going to go down? And they usually get it wrong. But people who invest regularly, month after month, no matter what is happening, no matter if it's a green day, red day, a flat day, tend to outperform the market timers. Because you ignore the noise, the news, the social media, hype, fear, none of it. None of it helps your long term plan. So if you can stay calm during market dips, you're already ahead of most beginners. So what do you need before investing? Well, this is just, in my opinion, but I would honestly start having an emergency fund. Now, ideally 1 to 3 months of expenses, so this protects you from unexpected costs, so you don't have to pull money out of your investments. I learned that the hard way, so I had no emergency fund. I was driving a car to work, and of course my car blew up, and I needed a car. I didn't have any emergency funds, so I had to turn to my investments and pull that out. And one of the investments I pulled out was a percentage of Rocket Lab. And of course, Rocket Lab, as soon as I pulled it out, about a month or two later, it skyrocketed. And I could have gained more on my investment than I did on the car. So you always have to learn. You always have to learn the hard way. But honestly, it's best to have an emergency fund. Secondly, avoid high interest debt. Now, of course, that could include credit cards, loans, because they grow faster than your investments. You pay those off first. And it's for the best, because it's the best return you ever get. And third, just have a simple budget. Know how much you can invest each month without stressing your finances. And once these foundations are in place, you're ready to invest confidently. So, where should you actually invest? Well, there's a lot of places, there's a lot of accounts, there's a lot of, types of investing. So, you need a brokerage account, of course, or if in the UK, I recommend getting a stock and share ISA. because an ISA is one of the best tools available because your investments grow tax free. So that means more of your money stays invested and compounds over time. But also don't forget pensions. Workplace pensions often include employer contributions, which is essentially free money. And if your employer matches contributions, take advantage of it. These accounts are simply containers, they hold your investments. So let's see what you can invest inside them. So before we do that, I want to say that my two suggestions for accounts to join is Trading 212 and Robinhood. Now they both have stock and share ISAs. Trading 212 have just offered a new account called the SIP, which is a type of pension. So when you invest in that, the government will include a contribution as well. So it's worth looking at them two types of companies to invest in. And of course, there is a link down in the description on Robinhood where if you sign up today, you'll get a free gift stock worth, I think it's up to $100 in your portfolio when you start investing. So, in the types of investments you should, I would always say for starters, do index funds and ETFs are the best starting point. They give you exposure to hundreds or even thousands of companies in one investment. They're low cost, diversified, and proven to perform well over the long term. Now, of course, at the start, avoid individual stocks because they're riskier, harder to research, and emotionally draining. Build your foundation with a broad, diversified funds and then explore later if you want to. Kind of think of index funds as the easy mode of investing. You're playing the game and you've got three difficulty modes: easy, medium, and hard. ETFs and index funds are the easy. Picking stocks, probably the medium difficulty, and of course the hard difficulty is like these high yield stocks that I have covered before, but they are so high risk. I wouldn't even recommend this in the first steps of investing. So how much money do you actually need? Well, we covered it at the start briefly, but it is one of the biggest myths in investing that you need a lot of money to start, but you don't. Most platforms, and the ones that we mentioned, Robinhood and Trading 212, they let you begin with a few pounds, especially a pound. Now, what matters isn't how you much invest into it, it's consistently how you invest. So, for example, you invest £50 over a month over decades, that can grow into tens of thousands of pounds, sometimes even more depending on the market return. Small amounts add up. Time and consistency does the heavy lifting. So how does compound interest actually work? Well, it's the engine behind long-term investing, and it works by your money earning returns, then those returns earn returns, and then over time, the growth accelerates. It starts slow, of course, almost invisible, but after years of consistent investing, the curve begins to rise sharply, like we saw at the start of the video. The longer you stay invested, the more powerful compounding becomes, and this is why starting early is such an advantage. So here to me is a simple portfolio you can start as a starting point. 80% into ETFs or global index funds and 20% into bonds if you want a smoother ride. Now, of course, this portfolio is diversified, low maintenance, reduced volatility, but also works in almost any market condition. You don't need dozens of funds, one or two is enough. Or if you are actually going on Trading 1-2 or you invest in Trading 1-2, there's a pie linked down in the description which I made and which I'm doing myself on this YouTube channel, and that is investing each week into VUSA and Main. Now, VUSA is an ETF for the S&P 500, and Main is a monthly income-paying stock. So, if you want to go and check that out, link is down in the description. So, what is the common mistakes to avoid? Well, checking your portfolio every day is definitely one that you should avoid. This creates stress, leads to emotional decisions. You see a stock that's going down that you finished your brought, you're more likely to sell it out very quickly and take the loss of a few percent. But stocks do go down. You can't help it. Even the best stocks in the market go down. So if you see that and you have some money that you think you can invest in, don't sell it. Add more if you think it's a good stock. Now, panic selling during dips, because dips are normal and they're part of the journey. But chasing hype and hot tips, and everyone's talking about it, you're probably quite late. Like SpaceX, everyone was talking how good that stock was, and it was also nearly hitting the $200 mark. And I think now it's at like 120. So it's fallen quite a lot in the recent past. So investment money you'll need to see. So short-term money belongs in savings, not stock market. And trying to time the market, like I said earlier, even professionals struggle with this because consistency wins. Avoid these mistakes and you'll be far ahead as most new investors. So what's your first steps? Well, for me, I would open up an ISA or brokerage account in one of the accounts that you can find. I recommend Trade1 in Robinhood. Pick up one global ETF or index fund. Automate your monthly contributions. Leave it alone and review once every year, or you can do it once every month or once every 2 months. Something comfortable that you would be happy to do, just not every day. And that's it. It's simple, repeatable, and effective. And if you found this guide helpful, subscribe for more simple investment videos or stock analysis. And I've got loads of stuff in my channel that will probably be helpful to you. And if you are new here, leave a like, hit the subscribe button, and I'll see you on the next one. Goodbye.